Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number 1 from the New Zealand Herald on the 6th of June, housing market rally stumbles as New Zealand and Auckland prices fall. Topic number 2, good returns on the 6th of June, geopolitics aside, investors take long view with buying intentions. Third topic from the New Zealand Herald on the 4th of June, high costs push more homeowners to seek homestay students and flatmates. Topic number 4 from RNZ on the 2nd of June, did we have to have the interest rate pain? Topic number 5 from interest.co.nz on the 4th of June, asking prices, new listings and total stock levels all sinking as the housing market heads into winter. So first up this week from the New Zealand Herald on the 6th of June, housing market rally stumbles as New Zealand and Auckland prices fall. The recent housing market rally has stumbled, with both Auckland and national prices falling for the second consecutive month, according to new data. Auckland's average home value dropped by 0.8% in May to 1.28 million, while Wellington values fell by 0.6% to 920,551, reports CoreLogic. Nationally, prices decreased by 0.2% to an average of 931,438. CoreLogic chief property economist Calvin Davidson noted that while the declines in April and May were small, the market's shift is evident. With mortgage rates expected to stay high, it's not surprising that the market has lost some momentum seen earlier this year. Davidson mentioned that the coalition government's planned tax relief and regulatory changes are unlikely to alter this trend. He highlighted that homeowners have managed higher bank fees due to a strong job market, but anticipated job losses could pressure the economy and prevent a short-term rally in house prices. Reduced job security could keep housing activity and prices subdued. Auckland saw the most significant price drops, with Waitakere being the only district where prices stayed flat. Manukau experienced the largest decline. Some city regions had even larger declines over the 3 months to May. Davidson remarked on the perception that Auckland leads the national property market and noted the city's notable early price drop. With more listings, buyers have gained bargaining power, and it remains to be seen if this trend will spread to other markets. Property analysts One Roof and Velocity also observed that while house prices are higher than last year, they have fallen in the past 3 months in Auckland, Gisborne and the Bay of Plenty. Auckland house prices declined by 1.1% over the past 3 months, according to the One Roof Velocity House Value Index. One Roof identified several market challenges, including the scrapping of the First Home Grant Scheme and the upcoming debt-to-income (DTI) ratio rules on the 1st of July, which will limit borrowing based on income. The Reserve Bank has also indicated that interest rates will remain higher for longer than previously forecast. However, One Roof's analysis suggested that sustained high interest rates could benefit first-time buyers by delaying the next price surge. Additionally, the easing of loan-to-value ratio, the LVR rules, from July 1st will allow banks to increase low deposit lending, which will also aid first-time buyers. So my thoughts on this is that it's nothing to get too excited about. We are heading into winter, which tends to be slower market activity in the real estate market in New Zealand. The important thing to point out also is that when they're talking about the house value index, the data for this report is based on settlement dates, not the date that the contract was entered into. It's one of the reasons that we prefer to look at the Real Estate Institute of New Zealand's house price index. So we'll wait and see how that data stacks up. But we often get fluctuations up and down from month to month throughout any 12-month period. So, I certainly wouldn't be freaking out about this at this stage. Let's wait and see until we get a bit more data coming in. Also, my thoughts on the Reserve Bank, I think I've made that pretty publicly clear. I potentially think that the reason that the Reserve Bank has introduced the debt-to-income ratios is because they know that they're planning on reducing interest rates sooner than what they've indicated, as soon as they've got the data to back the reasons up for that. So we'll wait and watch in the meantime, won't we? Second topic, from good returns on the 6th of June, geopolitics aside, investors take long view with buying intentions. Economist Tony Alexander notes that despite geopolitical upheaval and declining consumer and business sentiment, investors maintain a long-term focus. This is based on a May survey of over 30,000 subscribers regarding their personal wealth management. The results reveal that investors still favour assets influenced by geopolitics, as their long-term perspective makes short-term events less concerning. The Sharesies sponsored survey, with 947 responses, 70% of whom are aged between the ages of 30 and 65, showed the following investment asset distribution, excluding the family home. Less than $500,000, that's 28%, $500,000 to $2 million, 36%, $2 million to $5 million, 22%, and more than $5 million, 14%. In quarter two of 2024, 75% of respondents plan to add to their portfolios, which is down slightly from 78% in quarter one. Preferred assets for investments include shares, managed funds, and exchange-traded funds. Residential property and debt reduction are also notable. For those considering selling, residential property 17.5% and shares just under 15% are top choices. Alexander's report suggests that combining buy and sell measures can indicate future price pressures. Shares, managed funds, and EFTs remain popular, while interest in residential property has waned a bit, with net purchase intentions dropping to 4% from 11% a year ago and 17% in September 2022. Commercial property interest is also declining due to factors like interest rates, asset revaluations, and tenant stability amid economic stagnation. Earlier surveys showed a rise in saving intentions during uncertain times, but this has eased in the last 2 quarters, possibly due to good price gains in other assets, Alexander says. Also, potentially because people can't afford to save much money in this cost of living crisis that we've got. Investors show a strong preference for buying shares directly or through a broker, 45%, followed by ETFs, 20%, managed funds, 19%, and KiwiSaver, 13%. Interest in managed funds and KiwiSaver is trending upward again. If you'd like to learn more about investing in property and different methods of creating wealth, join me in one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced property investor and a financial advisor, and these events are available live, online, or in person in our office in Ellerslie, Auckland. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals as a client, then you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic this week, from the New Zealand Herald on the 4th of June, high costs push more homeowners to seek homestay students and flatmates. More Auckland homeowners are turning to homestay students or flatmates to manage rising living costs and high mortgage rates. Companies connecting families with international students report an increase in host family registrations driven by financial necessity. Erica Lima, who lives with her partner and 18-month-old, saw her weekly mortgage repayment rise by $300 after refixing her rates. She found a homestay student through multiple agencies, charging $325 per week. She provides 2 meals on weekdays and 3 on weekends. Before the student arrived, Lima had to rely on credit cards to cover increased costs. She plans to continue hosting as long as interest rates remain high. Rachel Hamlin, who runs a student host matching company in Auckland, noticed a recent uptick in families seeking to host students due to financial pressures. While cultural exchange remains a motive, additional income is becoming crucial. Hosts now include a more diverse range of people, including pensioners seeking both income and company. Families report that the extra income significantly helps with higher mortgage payments. Casey Pedersen from another homestay matching service also observed a rise in new hosts. Of 600 hosts in Auckland, 120 of them registered in the past 3 months. Some families depend on this income to cover costs, ensuring rooms are always filled to avoid financial gaps. First-time homeowners are also renting out rooms to meet mortgage repayments. Jamie Wood, who bought a 3-bedroom home in West Auckland 3 years ago, always had flatmates. Initially, renting out rooms was a way to save money, but now it's a necessity. North Shore homeowner Nicole, who bought her house 2 months ago for $920,000, is required by her bank loan to have flatmates. Struggling to keep up with her $1,000 a weekly repayment, she's only found one flatmate so far. She may need to ask her family for help or to find a second job if she can't secure another flatmate soon. Topic number 4 from RNZ on the 2nd of June, did we have to have the interest rate pain? The Reserve Bank has been grappling with New Zealand's inflation rate for nearly 2 years, as reflected in the adjustment of the OCR from a COVID low of 0.25% to 5.5% in May last year. This move aimed to curtail consumer spending and stimulate price increases, inevitably impacting interest rates and putting pressure on households and businesses with debts. However, economists suggest alternative strategies, each with its own set of advantages and disadvantages. Taxation. Craig Rennie of the New Zealand Council of Trade Unions proposes taxing company profits, higher income earners or luxury goods to dampen demand in the economy. Taxing excess profits directly reduces demand, unlike OCR adjustments, but it may prompt companies to relocate operations to avoid taxation, and it could lead to unintended consequences such as inflated prices in certain sectors. KiwiSaver adjustments. It's suggested that adjusting KiwiSaver contribution rates could help regulate demand by requiring individuals to invest more during periods of economic overheating. However, this would primarily affect workers and might not be as effective as OCR hikes in curbing demand, as the increased investment capital could still contribute to overall demand. Regulatory changes to boost supply. University of Otago's Dennis Wesselbaum highlights the importance of regulatory changes to increase supply and lower inflation. These changes could emulate the productivity boom seen in the United States, potentially alleviating inflation pressures. Targeting the source of inflation. Wesselbaum emphasizes the significance of identifying the root cause of inflation. Addressing the source problem directly, such as government overprinting money or external economic downturns, could be more effective than relying solely on interest rate adjustments. Reconsidering inflation targets. Rennie suggests deviating from the conventional 2% inflation target and aiming for a higher rate like 3% for a temporary period. This approach could expedite interest rate reductions, but may require consideration of potential banking sector and credit rating implications. Price controls. Eric Crampton of the New Zealand Initiative mentions past government attempts to implement price controls in the 1970s as a method to manage inflation. However, this approach is seen as ineffective and costly, merely masking inflation temporarily without addressing underlying issues. Each alternative presents its own complexities and trade-offs, underscoring the nuanced nature of managing inflation in a dynamic economy. Thank goodness I don't work for the Reserve Bank. I think it would be a very difficult job at the moment. Topic number 5 from interest.co.nz on the 4th of June. Asking prices, new listings and total stock levels all sinking as the housing market heads into winter. The latest data from property website realestate.co.nz indicates a decline in new property listings, total available stock for sale, and average asking prices. So this almost contradicts the first article that we talked about, doesn't it? In May, realestate.co.nz received 9,225 new listings, marking the third consecutive month of decline since the peak in February with 11,788 listings. Despite the decrease, May's new listings were still 25% higher than in May of the previous year. The total stock of properties also saw a decrease, with 32,598 residential properties available for sale by the end of May, down from 33,815 in April. However, compared to the previous year, stock levels were up by 22%. It's typical, as I mentioned before, for both listings and stock levels to decline during the quieter winter trading months. Average asking prices are also following this trend, dropping to 845,454 nationally in May after 3 consecutive months of decline from the February peak of 927,312. Although I think it is also important to point out that a lot of townhouse new builds have entered the market over the last recent months. And so that could also contribute to the reduction in average asking prices because townhouses tend to be a lower price point than larger properties on large sections, for example. Compared to May of the previous year, the average asking price decreased by $14,185, which, that's nothing to get too excited over, is it? That's just a fluctuation. Moreover, it's significantly lower compared to the record high of 994,885 in January 2022, which was just after the peak of the boom. So not surprising that it's significantly lower than those figures. These May figures suggest that the market is aligning with its typical seasonal trends, although the total available stock for sale remains relatively high. The decline in asking prices indicates that sellers may be acknowledging the buyer's market and adjusting their price expectations accordingly. Improving your financial position before buying property is crucial as it enhances your ability to secure favourable mortgage terms, afford a larger down payment, and comfortably manage ongoing expenses, such as mortgage payments, property taxes, and maintenance costs. If you want to make good financial decisions, join me at one of our free events called How to Succeed with Property Investing. During these 2-hour workshops, we cover recent property market data, and as an experienced property investor and a financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll tell you more about how we help our clients achieve their financial goals as well. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for our events. Alternatively, book a no-obligation phone call or meeting with my husband Paul Roberts through our website. Thanks for listening.